Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Chuck Fuller, Portfolio Manager in Nasdaq Dorsey, Wright, as well as Sanjana Prabhakar, Index Research Specialist with Nasdaq Global Indexes. We're here to discuss asset class sector ranking and what's been impacted in today's macro and market environments. It is great to see the both of you as always. Chuck, let's kick it off with you. Now, U.S. equities, it's been the #1 in asset class rankings. I can't even recall since when. Has there been any change there considering the market activity over the past month?
Yeah, there hasn't really been it's still at #1. We have seen some of the signals that kind of create the ranking pull back some, but it's still in a comfortable lead over the #2 asset class, which is commodities. And we think, with what's going on in the market right now, we've had, roughly a 10% correction. We think chances are that it's probably kind of run its course here. At least over the short term, we've had kind of a nice pop off the bottom, in the last week or so. And we're seeing some things, like the AAII survey has been just historically bearish here recently. If you don't know what that is, it's kind of a measure of retail investor sentiment. And so, people are more bearish than they are, around the same amount of bearishness as they were at the March 2009 lows, which is hard to believe considering we've only been down 10%. That market went down 50 to 60%.
Yeah.
So, things I think are a bit overdone, but, we'll see what happens, if we get a bounce here or not.
Yeah. And Sanjana, great to see you. Good to have you back on the show. And that's what you're hearing from, the fundamental and economic side of the equation as well, where it's somewhat of a wait and see until we get some clarity. Run through some of the economic concerns that you're focused on.
Yeah, Jill, great to be back. And as you mentioned, I think it would be fair to say that the economic story has gone head to head with the AI narrative in recent weeks. And to your point on the economic concerns, they have been front and center in the news. Just wanted to sift through some of the noise and highlight the key indicators that have had an impact on the markets. I think, as it's widely known now, uncertainty has been at unprecedented levels, specifically business uncertainty. As measured by the National Federation of Independent Business, that's soared to the second highest level in the 50-year history of the survey. So that points to some concerns, and we all know that investors are typically wary of uncertainty. Additionally, President Trump's on again and off again tariff strategy, which has been in the news, has also sowed a great deal of confusion in the minds of investors and the broader public. And I think that the overhang from tariffs has already been widely debated, so I'm not going to go into it in much detail, but consensus now points to the detrimental impact of tariffs on inflation, jobs, and growth.
Yeah. And Chuck, you had pointed out in your notes here that this is typically a seasonally strong part of the year on the calendar from November to April. What does that mean? We're coming up to May, and sometimes, still go away in May, right?
Right.
What
Yeah.
happened? What happens? I mean, I realize it's anecdotal and it's more of, a market story than anything else, but
Sure. Yeah,
seasonally, it's a little bit tricky.
it is, yeah. So yeah, November to April, typically seen as a seasonally strong period. Yeah, and you're only, we're a little bit over a month away from hitting May. And it's one thing I worry about because there's been this overhang for most of the year. We call it breadth divergence, where the market it's kind of going up, but the average stock isn't. And even with the pullback, we're still kind of seeing that. The market's probably down about 8% now from the high, but the average S&P 500 stock is about 18% off the high. And so somehow that needs to get that gap closed, or at least to to shrink somewhat. And so what I worry about is that kind of seasonally weak period comes up. Maybe we rally from here, but the rally's not that great. It could be maybe we get back to the highs, but it could be that the average stock didn't, and that's kind of what happened the first couple months of the year. I think if we see something like that happen, it just opens the window for kind of another leg down in the market. Doesn't have to happen, but that historically that's what you tend to see.
Yeah. Well, Sanjana, in fairness, there are areas of the market that are performing. What are some of your observations?
Yeah, I mean, well, In the recent weeks, we have seen some pockets of strength. I think Mark alluded this earlier in his trade talks. Much of the market weakness has been attributed to uncertainty versus decline in fundamentals. I think we'd like to reiterate that the fundamentals of several of the companies of the Nasdaq 100 actually remain strong. And I was just looking at the consensus estimates for the forward 12 months for companies in the NDX, and that's still a relatively strong number. We're looking at a 17% year-over-year growth rate. And also for the subsequent 12 months, we're looking at a 15% year-over-year growth rate. So I think it's safe to say that fundamentals for several companies in the Nasdaq 100 remain really strong. And with the AI narrative as well, we think that it's still alive while there have been some challenges, especially post the news of the DeepSeek. We believe that several companies are still well positioned to capture value, and that's something that we'll be watching closely.
Yeah, Sanjana, it's interesting because when we had Mark and Ryan on from Invesco last week, Mark made the point of saying that R&D spend is expected to be even higher next year. And I always find that stat to be encouraging, even though stocks might react in different ways. That's what sets up these Nasdaq 100 companies for future growth. And we've seen that in the historical performance of the index.
Yeah, absolutely. I mean, we closely track R&D spend of companies, is particularly in the AI space, and we have found that companies that invest more heavily in R&D outperform in the long term, and that's certainly an indicator of outperformance that we watch very closely. So I think it's encouraging that companies continue to invest very heavily in the space.
That's one of my favorite charts that your team shares with us. Let's talk about another area when it comes to rankings, Chuck. European markets and they were outperforming even before the uncertainty in the US markets emerged. I mean, this was somewhat of a value play because the risk was to the upside. And it's been quite some time where we've seen that divergence performance.
Yeah, international has just historically had a tough time, especially the last really 10 to 15 years. But yeah, this year it's been the exact opposite. I mean, you've got the MSCI All Country ex-US Index is actually up 10% this year. With the S&P down about 3. And within that space, like you said, Europe is doing extremely well. Also, Latin America is doing very well. Both of those areas are up 16% year to date. And a lot of it's been, yes, the developed European countries, but also a lot of these emerging European countries, places like Poland, Czech Republic, some different countries like that. I mean, Poland's up like 35% already year to date, which is pretty incredible. And within our rankings, emerging Europe has kind of been number one for a bit, and obviously still there with all the strength that we're seeing. Developed Europe's kind of number 2. And really, we haven't seen much of a change in our rankings there. It's kind of been holding steady with where it has been. We are seeing some rapid improvement in Latin America. It has been at the bottom because it had a really bad 2024, but seeing a lot of improvement there, and hopefully they'll start to make their way up the rankings.
Yeah. What are some of the trends that you're seeing within the commodity space? Still the number 2 in asset ranking. I mean, can't ignore gold here, right? It's up, as of last week, 13%.
Yeah. They haven't quite gotten moved up in our rankings. They're still kind of like number 3 in terms of precious metals. Really, agriculture is number 1 now. Energy was at number 1, kind of fell to number 2 with oil prices going down. One thing that's interesting is energy is actually the best sector in the S&P this year, and if you look at the stocks themselves, but we have seen some pullback in the commodity space. So yeah, it's interesting the rankings, I should say the signals that correspond to the rankings in our system. We've seen commodities continually kind of move up, as the U.S. equities have moved down. So that gap between U.S. equities and commodities is shrinking. It's still there's plenty of distance between them. So I wouldn't say it's like an imminent change coming, but really it's probably the closest change I've seen it in a while. U.S. equities just been so strong for so long, so it's going to be an interesting area to watch.
I'm glad you called out energy though, because while the underlying is not performing, the actual stocks are, and that goes back to Sanjana's point about the fundamentals of the company. And if you think about what companies have been through in the past 5 years, right? Think about migrating to cloud, that we have a pandemic, we have an election in there. There's been so much, right, that's happened in those 5 years. And a number of companies have operated quite well. right? So they're at least the baseline is they're positioned to weather this, relative to the fundamentals really being the issue. I think I'd be more concerned if the fundamentals were the issue. And the macro wasn't. This is just responding to the environment, not the actual, underlying fundamentals of the company.
Yeah, and really, when you look at the sector performance this year, I mean, 9 of the 11 sectors are positive for the year. I mean, I think that's a stat that not many people would think is true. I think what makes the market feel so bad right now is that the two sectors that are not doing well are technology and consumer cyclicals, and they're both down big, right? They're down like 7 to 12% respectively. So you got this kind of, again, kind of another divergence in the market. Things like, like I said, energy's up 8%, healthcare is up 6 to 7%. So there's a lot of things that are doing well, at least from a sector index perspective. It's just, tech and consumer cyclicals, which have been the leaders before,
Right.
have
Yeah.
been falling apart.
And Sanjana, to wrap up here, and I think this is the point that you're going to make. I want to ask you, is the worst of the sell-off over? There's a lot of noise in the headlines. The economic data is not that bad, and companies have been performing. We saw that during earnings. Do you think the worst is over, and this is just contingent on when we get some policy clarity?
Yeah, I would agree with you. I mean, I believe the worst of the sell-off is over. I think market participants are just looking for signs of consumer strength once we begin to see signs of consumer strength, and also the overhang from tariffs dissipating. I believe there will be a degree of optimism. And as you pointed out too, I mean, fundamentals continue to remain strong. We saw several companies in the Nasdaq 100 post very strong earnings in the recent quarter, and several of them have secular drivers of growth in place, which are going to hold them in good stead in the long term. So I think when the degree of uncertainty dissipates, there's likely to be more optimism.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.